Yeah, good morning, friends, and welcome to today's session of the IndAS education series. I hand over to the moderator, Grishma, madam. Grishma, all yours.
Thank you, sir. A very good morning to my fellow chartered accountants. So, hi, I welcome all of you all today to Mr. Anand Banka's session today on IndAS 101, first time adoption of Indian accounting standard. Mr. Banka is a fellow chartered accountant and he has added one more prestigious title yesterday to himself. He is now CA Dr. Anand Banka. Congratulations, sir, as he's completed his PhD in finance. He has also been awarded as a prestigious Indian Young Achievers Award by prestigious Indian Achievers Forum. He also holds a diploma in Information Systems Audit and diploma in IFRS. He has delivered over 300 lectures in India, USA, UAE, and Nepal. He has over 12 years of experience in helping companies. He has written books and published by Walton Kluwer, Indian AS Simplified with Illustration, Extracts and Disclosures, Comprehensive Guide to Ind AS, and Comprehensive Guide to Indian GAAP. He is a special invitee to Accounting Standards Board of ICAI. He is also a faculty for ICAI certificate course of IFRS. He is a coordinator and a faculty for National Mission of Ministry of Human Resource of India for implementing accounting standards of government-sponsored education institutions like IIT and IIM. In addition to conducting training sessions, Mr. Banka has penned several articles in Bombay Chartered Accountant Journal, WIRC reference manuals, and has contributed significantly to various ICI publications. So I hand over the session to Mr. Anand Banka so that he can enlighten us on this particular standard. All over to you, sir.
एक मिनट. Yeah, unmute करिए.
Thank you so much, sir. Sorry.
Sure.
Okay. Thank you, Grishma. Thank you so much for the kind introduction. I hope my voice in the internet is fine.
Yeah.
Okay. Thank you so much. Yeah. Good morning, friends. Today we'll be doing IndAS 101. Normally, this is taken as last session because the standard covers all other standards. IndAS 101 as such is one of its kind because it's not an accounting standard as such, because it does not give guidance on accounting as such. Okay, it's more of giving guidance how to apply other standards, and how to apply other standards only for the first time. Okay, once you have applied this standard, then you cannot apply this standard ever again in the lifetime of the company. So it is applicable only once. Okay, and like I said, this is one of its kind because this kind of standard is not there in any other standards. It's not there in US GAAP, it's not there in Indian GAAP, it's not there in UK GAAP. No other GAAP has this kind of standard. This has a history, and we'll have to go back to the history to understand why this standard was required in the first place. Now, if we go back to history, wherein IASC was formed, International Accounting Standards Committee. That committee included 10 countries like US, UK and all, wherein the objective was to create a set of standards which can be applied by all companies across the world. Okay, a standard which is across the world common, so that anyone across the world can read any balance sheet. Okay, if it's written in different accounting standard is like a language. Okay, so if it's UK GAAP will speak something else, US GAAP will speak something else, and Indian GAAP will speak something else. If I prepare my accounts in Indian GAAP, someone from US may not feel comfortable reading my financial statements because they will not know what policy I have applied, how I have applied, whether my property, plant and equipment or fixed assets is at cost, carrying value, fair value, what method have I applied, they will not be as clear. Okay. So they felt that there is a need to have a common set of standards across the world. Okay. So they formed this committee, and many countries started joining this committee, harmonizing their local GAAP to the international GAAP. So India also did that, and before India even formed the Accounting Standards Board, which was in 1977, before that India committed to IASC that all our standards will be harmonized to the international standards. Okay, so in fact, all our accounting standards are harmonized to the IAS, International Accounting Standards. Although with time, IAS kept on evolving and kept on revising their standards, and Indian GAAP was left a little behind, and hence we now feel this big leap which we have to take to adopt IFRS or Ind AS, which we call now. So many countries like India committed that we will harmonize our local GAAP in accordance with the international GAAP. However, not many countries adopted the international GAAP as it is. Okay, they said that okay, we'll read international GAAP. We will try and incorporate as much as possible of the international GAAP in the local GAAP, but we will modify it to suit the local environment. Okay, local business environment may be a little different from the international ones. There might be transactions locally which might be a little different from the international ones. Okay, so most of the countries felt that we should create a local GAAP, okay, which is in line with the international GAAP but suited to the local environment. Okay, come to year 2000. Okay, year 2000 also had similar thing wherein same thing, like I said, almost 130 countries committed that we will go in line with the international GAAP, but still having local GAAP. So in 2001, okay, the till that time the name was changed to International Accounting Standards Board. Okay, so in 2001 the IASC changed its name to IASB. IASB issued IFRS 1. Okay, IFRS 1, so they renamed the standards to IFRS. Okay, because they felt that these are reporting standards rather than accounting standards. Again, the objective being that not just accounting, okay, not just accounting, we should also take care of the disclosures. Okay, we should take care of the reporting rather than mere accounting, and hence they changed the name to IFRS. Again, they could not change all the standards names, so what they said was, here on, after 2001, any standard that will be issued will be named as IFRS. So the earlier standards continue to be named as IAS. The new standards that will be issued, okay, either they will replace the earlier one or will be on a new topic. Either ways, they will be named as IFRS, Financial Reporting Standards. Now, the objective of IASB in 2001 was that now countries, it's high time countries are having their local GAAP. They might be more or less in line with the international GAAP, but they're still in local GAAP. Okay, India says that we have Indian GAAP. UK says UK GAAP. Singapore says Singapore GAAP. Hong Kong says HK GAAP. So everyone has their own local gaps. Okay, so it's high time that everyone should move to one single language, which is IFRS. Okay, what I should do is probably I should switch off my video. Maybe that will help manage the bandwidth. Is it any better now? No. Okay, 1 second. I'll just maybe move somewhere. Is this better now?
Yes,
Yes.
it is better. Yes.
Okay. Thank you so much. So yeah, so this helps now. Okay. So I was saying that in spite of we are now in 2001. Okay, in spite of so many years, we are talking like almost like 27, 30 years now. 30 years later, also countries having their own local GAAP and not moving to a single international GAAP, which was the original objective. Okay, now because of this, IASB created initiated IFRS 1. The objective of IFRS 1 was that everyone should move to international accounting standards and should not have their local gaps. Now, when they created this IFRS 1, okay, the first idea or the initial issue which they sought from all the countries was, what is the issue in moving to international accounting standards? Why you want to stick to your local GAAP and why not move to international GAAP? Now, even though countries may want to move to international GAAP, the issue therein was that the standard, international standard, said that you have to apply every standard retrospectively. Now imagine if I started my company in say 1960, 1970, okay, 30, 40 years back. I have a lot of machines, lot of property premises, factories, all that stuff. Okay. Now if in year 2010, I have to move to IFRS, okay, it says that everything needs to be applied retrospectively. All changes in accounting policies as per IAS 8 is retrospective. Okay, so if I now move to IAS, International Accounting Standards, I will have to go back and recalculate the cost as per international standards. Why recalculate the cost? Because as per IAS 16, as per IAS 16 on property, plant and equipment, cost of an asset will include decommissioning liabilities. You need to do component accounting. That means break the asset into various major components and depreciate the components over their own useful life. Depreciation is basis useful life and not basis schedule 6, schedule 2 rates. Okay, that time schedule 14, now schedule 2. Okay, so it's not a flat rate of depreciation. It's based on useful life. So we have been, until the schedule 2 was there, schedule 14 always spoke about a flat rate of depreciation or a minimum rate of depreciation irrespective of the useful life. So there have been a lot of reasons why you will have to recalculate the cost, recalculate the depreciation, and hence your carrying value will be different under uh, your carrying value will be different under IAS or IFRS as compared to what you have under Indian GAAP. Now that I am talking about say one asset, but when you think of it, same concept will apply to thousands and thousands of assets. You know, I will take years and years together to actually move from my Indian GAAP to IndAS or IFRS. Okay. Hence, it was necessary to make this change from local GAAP to IFRS. It was necessary to smoothen the process. It was necessary to ease out the process. Hence, it was necessary to give some relief to all the countries and companies. Now, how do you give relief? So they came up with certain exemptions and exceptions in IFRS 1. These exemptions and exceptions are from retrospective application. That means for a particular line item, if there is either an exemption or an exception, then for that line item, you need not go back to the date of transaction, and you can do it from a different date. That date will be mentioned in that exemption exception. Normally it might be prospective, or most of the cases it is prospectively. Okay. For example, let's take property, plant and equipment. IndAS 101 gives an option that for property, plant and equipment, you need not recalculate the carrying value like I just explained. You can assume that the carrying value as per Indian GAAP, as on, just for example, say 1st April 17, date I will come to how the date is taken, but just for now, assume that it is 1st April 17. So your carrying value as per your Indian GAAP of fixed assets as on 1st April 17 will become the cost, deemed cost for IndAS. So we start prospectively. Now you know that you need not go back. This is your starting point. From here you apply IndAS. Life becomes easy. Companies feel comfortable shifting from local GAAP to IndAS. And that is why IndAS 101 is very, very important. Okay. Now I said there are exemptions and exceptions. Exceptions are mandatory in nature. That means for those line items where you have exceptions, you cannot go back. Okay. Whatever is mentioned in IndAS 101, you have to mandatorily do it. You don't have option there. When I come to exemption, okay, exemptions are optional in nature. Okay, if you if I can just try and compare it with our CA exam exemptions. Okay, if you procure more than 60, you get an exemption. In next exam, you have option whether to avail that exemption or not. So it's like optional exemption. Okay, so in case of optional exemptions, you have option whether you want to avail that exemption or not. If you choose not to avail the exemption, you will have to go back to the date of the transaction. Like I said, for property, plant and equipment, you still have an option to go back to the year when you purchase the asset and then you recalculate the cost, the decommissioning liability, component accounting, useful life, and you come up to today's date, and that will be your revised carrying value. Okay, so this is the nature of the standard. Like I said in the start, this is not a accounting standard as such, because this standard does not give you accounting. Okay, this just tells you how to create your opening balance sheet, how to measure line items in your opening balance sheet, what items to recognize, what to not recognize, what to disclose only in your first balance sheet as per Ind AS. Once you have prepared your first balance sheet as per Ind AS, this standard is not applicable ever after. Okay, so once you read this standard, once you have applied this standard for a company, this standard will never be applicable after that. Okay, hence, like I said, it's one of a kind. It will be applied only once in the lifetime of a company. Okay, with that background, let's start with the standard. Okay. Firstly, if you have noticed the IFRS structure of IFRS is, the structure of IFRS is little different from the structure of IAS. Okay, or if you want to talk in Ind AS terms, the structure of Ind AS 101 to Ind AS 116 is different from the structure of Ind AS 1 to Ind AS 41. Okay, Ind AS 1 to Ind AS 41 are more or less in line with at least the structure. Okay, the contents may be little different, but the structure is like your accounting standards. When I say structure, it starts with introduction, then scope, then definition, then initial recognition, measurement, subsequent measurement, presentation, disclosure. Okay, maybe derecognition in certain standards. So this is the structure of all our accounting standards, and also Ind AS 1 to 41, which is like IAS. When you see IFRS, which is Ind AS 101 to Ind AS 116, the structure is completely different. Okay, when I say completely different, why? Because the definition is in Appendix A. Okay, the explanation of the standard, how to apply this standard, okay, what the standard means, is given in Appendix B. For example, let's say consolidation standard. Okay, consolidation standard gives two options to calculate your minority interest, which we call as non-controlling interest. Now, what are those two options? It says either you can do proportionate fair value of the net assets. That means if non-controlling interest is 30%, then you calculate the fair value of net assets and allocate 30% to non-controlling interest. Option number 2 is you fair value the non-controlling interest itself. So you fair value the 30%. Okay, fair value of business is different from fair value of assets, that you are aware. And hence, fair value of 30% of net assets will be different from fair value of 30% of the business. Okay, so you have these two options. Now, the standard will say that you have these two options. How to apply this option? Okay, how to get into the details and understand these two options? You go to para B100 to B120. That means I'm just giving rough para. I don't know the para numbers by heart, but I'm just saying that you go to Appendix B, para 100 to para 120 to understand how these two options can be applied. So you will have to read the Appendix B and the standard together to understand the standard. Okay, that's how IFRS is structured. Similarly, this IFRS 1 or Ind AS 101 is also structured differently. There are 5 appendix or appendices. Appendix A is definition. Appendix B is exceptions, which are mandatory exceptions. Appendix C is exemption from business combination, exemption from only one standard. Appendix D is all other exemptions. And finally, Appendix E is short-term exemption. Short-term exemption means this exemption is only given for a year or two. Okay, it is not given after that. So if your company implements IFRS for the first time or Ind AS for the first time in that year, then Appendix E will apply. If you implement Ind AS after that year, then Appendix E will not apply. So it is only given for a short period of time. Okay, this is generally where some new standard is applicable from that year. So around that year, this IndAS 101 is amended and Appendix E gives an option. Otherwise, Appendix E remains blank. Okay. So this is like where for short time you park certain exemptions and then that exemptions are taken away. Now this is one of the most critical slides in the deck. Okay. Now this slide talks about what are the dates which are important dates in transitioning to Ind AS. Okay. Now, firstly, it says, one very basic principle of Ind AS is the comparative year, the numbers which you present in the comparative year, the comparative balance sheet should be actually comparable. Okay. And how do you make it comparable? By not making any adjustments in the comparative financial statements. Comparative balance sheet P&L should not have any adjustments, okay, which is different from what you have in the current year. That means previous year should have the same accounting policies, same way of implementing them, everything same as it is in the current year. It cannot be different. Okay. If you have different accounting policy in previous year and different accounting policy in current year, then it is not comparable, right? So the basic principle which is driven by IAS 1 and IAS 8 is comparative period is meant to be comparative, is meant to be comparable, and you have to make it comparable. So no adjustments in the comparative year. Where to make adjustments? If I change my accounting policy, if I have a error, prior period error, if there any such scenario, where do I make adjustment? So it says all adjustments you need to make in something called as opening balance sheet. What is opening balance sheet? Opening balance sheet is the opening date of the comparative year. For example, on the screen, your main financial year is 16-17. Okay, so your reporting date is 31st March 17. 16-17 is your financial year. Okay, for 16-17 to be the financial year, the comparative year is 15-16. Okay, so like I was saying, 15-16 PNL should be comparable with 16-17 PNL. March 16 balance sheet should be comparable with March 17 balance sheet. For this to happen, I need to change my opening balance sheet, which is 1st April 15 balance sheet. Okay. If my 1st April 15 balance sheet is first adjusted with all the adjustments and made in line with Ind AS, okay, in that case, the depreciation, amortization, impairment, everything will flow to PNL correctly. Okay, because your opening balance is correct. So the PNL automatically becomes correct and your balance sheet becomes correct of the comparative year. And hence your current year is anyways correct, right? So that is how you correct your previous year. I'll repeat. Okay. 1st April 15 balance sheet, I make all the adjustments so that the balance sheet is comparable. Balance sheet is in line with Ind AS. 1st April 15 balance sheet is as per Ind AS. So that I will prepare first. So once my closing balance of 1st April 15 is as per Ind AS, okay, then I just need to depreciate, amortize, impair the assets, de-recognize the assets or whatever. Okay, so my PNL becomes normal, right? PNL becomes proper. There is no adjustment in the PNL of 15-16. Okay, it's a normal PNL. Again, my 16 balances are correct, March 16 balances, because my opening balance was correct, my PNL is correct, so my closing balance is correct. So March 16 is correct, and hence that's how I make my 15-16 comparable. All adjustments I have to make in opening balance sheet, which is 1st of April 15. What adjustments am I talking about? So for example, I will take you to Excel and I will explain what adjustments actually I'm talking about. Say I have fixed assets. Okay, fixed assets carrying value as per Indian GAAP and as per Ind AS. Okay, fixed assets carrying value as per Indian GAAP is 120. As per Ind AS, because of the decommissioning liability or whatever, depreciation, component accounting, whatever you may call it, the carrying value as per Ind AS would have been 100. As per Indian GAAP is 120. So I need to make adjustment of 20. Okay, so that my Ind AS balance becomes correct. So what I will do is this numbers, this 120 will be on 1st April 2015. This will also be on 1st April 2015. Okay. Once my Ind AS number, which is 100, is correct, okay, my PNL will have what? My PNL will have depreciation. So depreciation on 100 will be correct because I will apply say 10% depreciation. So my depreciation is correct. My 31st March 16 balance is also correct because it is 100 minus 10. Okay. My depreciation of next year is also correct because again I am applying 10% for 90, and my definitely closing balance, which is 31st March 17, is also correct. So basically by making all adjustments here, okay, this goes to say retained earnings. By making this adjustment of 20 here, I am ensuring that my PNL and balance sheet of the comparative year is actually comparable. So this 10 is now comparable with this 9, and this 90 is comparable with this 81. Okay, I do not make adjustment in the PNL. What other option I could have had, or what I generally do in Indian GAAP, is I make adjustments in the PNL. Okay, so I leave this 120 here, then my first adjustment in PNL will be minus 20, and then depreciation of 10. So my PNL here will have balance of 30. Okay, whereas ideally my balance should be only 10. Hence, this 20 adjustment I don't make in PNL, I make in the opening balance sheet in the retained earnings. Okay. If you have any questions, you can please post it in your chat box. I will take up all the questions as and when I am taking the session, so that your queries are all resolved while I continue the standard. Okay, don't carry your questions till the end. Okay. So yes, I was saying that this is important because my comparative year is comparable. So all adjustments I make in my opening balance sheet. Let's take an example that you are preparing your first Ind AS balance sheet as on 31st March 20. Okay. So how do I prepare my first opening balance sheet? Okay. Or what are the important dates? So my reporting date becomes 31st March 20. My financial year, first financial year, becomes 1920. My comparative balance sheet becomes 31st March 19. My comparative financial year becomes 1819, and my opening balance sheet becomes 1st April 2018. So for preparing my 1920 financials, I have to ensure that my comparative financial year 1819 is actually comparable. So I need to make all adjustments in my opening balance sheet, which is 1st April 18. Okay. Similarly, last example, if I were to prepare on 31st March 21, okay, just so that we are very, very clear. Okay. This will become 21. This will become 2021. This will become 20. This will become 1920, and this will become 19. So simple. Okay. So you just need to go a year back, and the opening of the previous year becomes your opening balance sheet. All adjustments to be made in this opening balance sheet. Okay. All adjustments will be made here. Comparative year will be comparable, and this is my anyways the first Ind AS balance sheet. So that's how things happen. Let's go back to the slide. Okay, so in the slide also, if you see, my 1st April 15 becomes date of transition or Ind AS opening balance sheet. 15-16 becomes comparative year. 16-17 becomes first Ind AS financial statements, and March 17 is my reporting date. Okay, so if you change your reporting date, automatically all other dates will change accordingly. Now that means, what are we doing? Okay, we are presenting 3 balance sheets, right? One is my opening balance sheet, which is 1st April 15. Then I have my comparative year balance sheet, which is 31st March 16. And my current year balance sheet, which is 31st March 17. I have only 2 PNL. okay, which is comparative year and current year. I don't prepare P&L for my opening balance sheet. I just prepare opening balance sheet, right? So comparative year P&L, current year P&L, comparative year cash flow, current year cash flow. Then there is something called as SOCI, statement of changes in equity. This also I prepare only for comparative year and current year. I don't prepare for opening balance sheet. And finally, I have notes and comparative information, which is also for 2 years. So effectively, I have my 3 balance sheets and everything else is 2. Okay. This is the same scenario if after applying IFRS also or Ind AS also, if ever you change your accounting policy. Okay. If ever I change my accounting policy from say your IAS 16, which is property, plant and equipment would be done. So there you have two options. Either you apply cost model or you apply revaluation model. Now that's a change in accounting policy. So if you change your accounting policy, you will have to follow the same methodology, which is 3 balance sheets, 2 P&L. Okay. This is the case in any change in accounting policy across any standard. If ever you change your accounting policy, this is what you have to do. This is also the same scenario if there is a error. Okay. Suppose while preparing March 20 balance sheet, if you find error which has been conducted, which was error which was done say 3 years back or 4 years back. Okay. You need to go back at least till your opening balance sheet date. Okay, opening balance sheet date will be for March 20. It will become new opening balance sheet to say so, which will be 1st April 18. So all adjustments relating to prior period error, which was before 1st April 18, will be made on 1st April 18 balance sheet, so that you don't make any adjustments in 1819 and 1920. 1819 and 1920 remain pure and comparable. Okay. So Ind AS 1, this concept is same as what you applied in change in accounting policy or change in error, prior paid errors. Now, what are the steps to prepare your first Ind AS financial statements? Okay. What are the steps? The first step is you need to remeasure. Okay, there's a question before I go ahead. There's a question. While preparing FY 2021 financial statements, error identified in 1920. Okay, if the error is identified in 1920, then Sanjay, you will have to adjust in 1920 only. And because the basic assumption is once you adjust the error in 1920, 1920 then becomes comparable with 2021. Okay, because then you are presenting the correct 1920. And correct 1920 is comparable with 2021. The wrong 1920 is not comparable with 2021, right? So if error is in previous year, then you will adjust in previous year. Then you will not go to opening balance sheet because opening balance sheet never had any error. Okay. Okay. So let's go back to the steps which I was saying. The first step is there are measurement differences. Okay, what is measurement differences? There are 2 types of measurement differences or 3 types. First is the basis of measurement may be same, but how to apply that basis may be different. For example, cost. Okay, I explained that cost of fixed assets will be different as per Ind AS and as per Indian GAAP. Both say, Indian GAAP also says that fixed assets should be initially measured at cost. But cost as per Ind AS will be different from cost as per Indian GAAP. Why? Like I said, there is decommissioning liability. There might be certain discounting which is required. So there might be certain other things which might be required because of which cost is different. Similarly, say measurement of provision. Okay, how do you measure provision? You estimate. Okay, provision is basis estimation. Under Indian GAAP also, Ind AS also. But under Ind AS, provision you need to discount, you need to apply probability, you need to do a lot of adjustments which may not be applicable in your Indian GAAP. So the basis, which is cost, which is revaluation or which is estimation, the basis may be same, but the application of basis may be different. So first you need to remeasure because same basis but different application. Second can be the basis itself has changed. For example, when I invest in an equity, okay, Indian GAAP said that investments in equity should be, which is current investment, should be cost or market value, whichever is lower. Okay. Whereas investment in equity as per IFRS is always at fair value. So the basis itself has changed. So I need to change the basis. So when I prepare, see, these steps are preparing my opening balance sheet, which is 1st April 17 or 1st April 15 in our previous table. So here it is 1st April 15. Okay. How do I prepare my 1st April 15 balance sheet? I take all the assets, liabilities, see how they are measured. Okay. Individually, all assets and liabilities I take. Say fixed assets, I said it is measured at cost, but how to apply the cost may be different. So I need to change that. Second is basis. Okay. So my financial instruments, I gave example that short-term investments may be cost or market value, whichever is lower as per Indian GAAP, but will be fair value as per IndAS. So basis itself has changed. So I need to change measurement of financial instruments in my opening balance sheet. The third is in a lot of scenarios, discounting is either required or prohibited as per Indian GAAP, and it's reverse in IndAS. For example, provisions previously were not being discounted. I think now there is amendments and some provisions are required to be discounted as per Indian GAAP also. But earlier provisions were not being discounted. IndAS requires discounting of provisions. Similarly, liabilities, creditors. If my creditors give me a credit period of more than 1 year or an extended credit period to say so, okay. If there's extended credit period, Indian GAAP never required any discounting of my creditors, but IndAS requires discounting of creditors. So I need to discount my trade payables. Okay. So there might be a lot of such examples where discounting previously was not allowed, prohibited. Now it is mandatorily required to be discounted. So a lot of such examples. Other can be your simple revenue, debtors. Okay, you give credit period which is extended credit period. Then also you need to discount. Okay. Then there are loans, interest-free loans given by parent to subsidiary. Okay. Indian GAAP, no adjustment required. Ind AS, you need to discount it and calculate how much is equity infusion by parent to subsidiary. Okay. So a lot of such adjustments which are required when you move from your Indian GAAP to Ind AS. Okay. There's a question from Sanjay again. Discounting of trade payable is only done if credit period more than 1 year. Yes, Sanjay. So the concept there is, one is there should be extended credit period. Secondly, the interest portion should be material, and generally it is assumed that anything which is less than 1 year, the interest portion will not be material. Okay, that's an assumption. If it is material, then you will have to do it for lesser period also. Okay, so I am saying a generic assumption. Generally you don't do it, but there is nothing written in the standard that you cannot do it for less than 1 year. If amount is material, you will have to do it for less than 1 year also, but it is definitely not for a normal credit period. For example, if in the industry in which you are, or the material which you are purchasing in that industry, if the credit period is 1 to 3 months generally, then you will definitely not discount anything which is less than 3 months, or say 4-5 months also. Okay, it has to be extended credit period more than the normal credit period given to you. Only then you do discounting. You don't do discounting for every transaction. There's also a saying, Sanjay, just on that point, the standards, the framework in which the standards are made, it says that cost of applying a standard should not be more than the benefit the investors draw from the financial statements. Okay, so if you are required to discount every transaction, then the cost of implementing Ind AS will be so high, okay, that the benefit will be lost. Okay, So definitely you don't need to discount anything which is, generally we take it as 1 year. So anything which is less than 1 year, generally we don't discount, because it does not, justify the costs. So yes, that's the first step. That's the first step of preparing the opening balance sheet. The second step is reclassification. Okay, reclassification, something which is debt under Indian GAAP can be equity under Ind AS, or something which is equity under Indian GAAP can be debt under Ind AS. Okay, so it can be completely opposite classification. For example, uh, let's start with the easy ones, and then I will take you to the difficult examples. And I know IndAS 32 is done, and that is why I say that this standard is the last to be done, because then you should know all other standards to understand this standard. Okay, so IndAS 32, you would have done this, how to classify a financial instrument into debt or equity. Okay, but I'll still take up a few examples here. Say preference shares. Okay, redeemable preference shares. A redeemable preference share, though, may be part of your equity as per Indian GAAP. Okay, shareholders funds as per Indian GAAP. But if it is redeemable, then it's a liability, obligation to pay cash or obligation to pay any other asset. So uh, that's what liability is. So under Ind AS it will be liability, although Indian GAAP preference shares is shareholders funds. Say another example, compulsorily convertible debentures, CCDs. Okay, compulsorily convertible debenture. If it is convertible into fixed number of equity shares, so every debenture will get converted mandatorily into 2 equity shares. A compulsory convertible debenture is equity as per Ind AS, but debt as per Indian GAAP. Okay, so first I gave an example of preference shares, which is shareholders funds as per Indian GAAP, but debt as per Ind AS. Now I am giving an example CCDs, which is debt as per Indian GAAP, but equity as per Ind AS. Okay, so completely opposite transactions. Then you think of equity shares, pure equity shares. Now, many of these VC funds or private equity players, when they invest in equity, they have a put option. Okay, so puttable equity shares. Put option is that if at the end of say 3 to 5 years, depending upon the transaction, okay, every equity player might have different terms, or every transaction might have a little different terms. Let's say 3 years, for example. Okay, so at the end of 3 years, if the company does not get listed, okay, how do I get an exit? If I am a private equity player, I have invested in your company, how do I get an exit? You are not able to pay me, right? So you will have to get listed. During listing, my shares, go for listing, essentially offer to normal shareholders, to the equity shareholders, public at large, and that's how I get my money back. So if at the end of 3 years or between 3 to 5 years, the company does not get listed, then I as an investor have right to put my shares back to the company and make company pay me for those shares. Okay, which is at a IRR of say 25%. That means if I invest 100, I need to get 25% return every year. So in 3 years, it will be say 180, because 25% on 25 compounding interest. Okay, so assuming 180, so at the end of 3 years I should get 180 from your company. If you do not get listed, you will have to pay me 180. Now this is an equity share which you have issued, but we have a shareholders agreement which mentions this clause. Because of this clause, the equity shares that I hold will be classified as liability under Ind AS. So even equity shares as such can be classified as liability as per IFRS or Ind AS. Okay. So classification is very important under Ind AS, and hence you need to reclassify or at least relook at all line items and see whether it is a debt or an equity. Okay, and then change the classification of those line items accordingly. The next point under reclassification is current non-current. Now, generally the definition of current non-current under Indian GAAP and IndAS is same. However, there are some changes because of the guidances around the definition, how to apply that definition. For example, okay, the guidance note on schedules, previously revised schedule 6 and now schedule 3, okay, as per Indian GAAP, it says that if there is a covenant breach, and because of the COVID scenario, there are a lot of covenant breaches now. Okay, so if there is a covenant breach, and that covenant breach is rectified. So generally, first let me give you generic principle. If there is a covenant breach of a long-term loan, long-term debt, okay, from a bank, which is a non-current loan, okay, but if there is a covenant breach and it becomes a demand loan, then the standards required me to reclassify that non-current loan into current liability. Okay, that's a requirement, mandatory requirement. However, the guidance note on schedule 3, it says that if the covenant is waived off before the signing of the balance sheet, okay, post balance sheet date. So as on the balance sheet date, your covenants have breached, but post balance sheet date, before the signing of the balance sheet, if those covenants are waived off by the bank, or if that breach is waived off by the bank, then you can continue to classify it as non-current. That is Indian GAAP. Okay. If you come to IFRS, IFRS strictly says that if on 31st March, which is your balance sheet date, if you have breached a covenant and it has become current, then you have no option but to classify that loan as current, even though the bank may later on waive off the covenants, but still you need to classify them as current and current only. Okay. Now, under Ind AS, okay, there's a carve out. That carve out is essentially similar to what I said for Indian GAAP, which says that yes, if the breach is waived off in writing, okay, then you can take it as non-current. So first of all, IFRS says current. Ind AS says if the bank waives off the breach in writing, then you can classify it as non-current. So there's a difference between IFRS and Ind AS. Now, there's one more difference between Ind AS and Indian GAAP. Indian GAAP further says that if the breach is a minor breach, okay, minor breach, for example, non-submission of your stock statements, okay, if the breach is a minor breach, then wherein, you know, historically or normally you do not expect bank to call the loan or demand the loan back, then also you can continue to classify the loan as non-current. Okay, so let's take this example that you have breached the inventory stock statements you have not submitted. So a minor breach as per Indian GAAP. Indian GAAP will classify it as current. Ind AS will classify it, Indian GAAP will classify it as non-current. Ind AS will classify it as current, unless it is waived off in writing by the bank. And IFRS in all scenarios will classify it as current, even though it might be waived off by the bank. So in this scenario, current non-current classification different in IFRS, Ind AS and Indian GAAP. All three are different. Okay. So again, this is critical aspect you need to take care. So firstly, I said you need to remeasure basis. The basis may be different, or the application of basis may be different. Secondly, then discounting may be different. Secondly, we did classification, debt equity, current, non-current, some other classification. So you need to see any other example of classification that may be different and reconsider for Ind AS purpose. Okay, Sanjay has a question. Loan taken and given classification changes if the same is repayable on demand. Yes, Sanjay, anything, see, loans given, asset side, you need to see the expectation. When do I expect to receive? Okay, even though I can demand, if I do not expect myself to demand the loan back from the borrower, and I feel that this loan will come only after 1 year, then even though it's a demand loan given, I can still classify it as non-current. On the liability side, okay, I don't have option. I cannot go by expectation. I have to go by the legal requirements. If it's a demand loan, that means the lender has a right to demand it anytime he wants. So borrower will have to classify it as current. Borrower has no option. The lender can continue to classify it as non-current, but borrower will have to classify it as current. So asset side, you go by the expectation of recovery. Liability side, you go by the legal provisions, what is as per the contractual provisions. Okay, so if contractually you may be required to pay at any time, then it's current. So I hope you are able to differentiate between the loans taken and loans given. Okay, so next steps is you have to consider whether to apply any of the optional exemption from retrospective application. So like I said, there are optional exemptions. You need to go through each of them, and you need to decide whether you will apply those exemptions or not. Okay, it's your choice. There might be certain benefits of applying exemptions. Some companies find benefits even by not applying exemptions. For example, say business combination. Okay, it says that you need not restate past business combinations. So there is option given that if you don't want to restate past business combination, don't restate. But some of the companies feel that bringing fair value on the books, okay, uh, might help better the books, or might reflect the true picture of the on the books, and hence they voluntarily go back and restate business combinations. Okay, so you need to decide what is better for your company, what is better for your investors, what is better for your financial statements, whether you need to apply those optional exemptions or not. So there's a question from Vrutika Patel. If there's a mistake in calculating depreciation of 1718, same mistake in 1819, and we are making financials of 1920, how to correct such mistake? Okay, and how to report? So Vritika, if there's a mistake in 1718, so first you need to go back and change your 1st April 18 balance sheet, your opening balance sheet, assuming your opening balance sheet is 1st April 18. Okay, go back and correct that mistake in the opening balance sheet. 1819 you will correct in the 1819 financial statements. 1920 is anyways correct, or you can arrive at the correct number. So if I take you to the Excel sheet and show you how it is to be done. Okay, let's say 1819, sorry, 1718, 1819, 1920. Okay, now depreciation recognized and correct depreciation. Okay, now depreciation recognized is say 100, correct would have been 120. Now here depreciation recognized again is say 90, but sorry, let's continue 100 only and 120. 1920 anyways you can recognize the correct one. Now this is the mistake which you have done. Okay, now if you have done such mistake, first of all, my 1st April opening balance sheet, I will adjust my PPE and RE. So what entry I will do is RE debit 20 to PP. Okay, so my PP I have reduced by 20. Okay, then in this 1819 I will change my PNL. Okay, so I will have depreciation expense debit to PP. So here I will debit my PNL, credit my PP. So anything before 1st April 18 I will give effect in RE. Okay, 1819 I will give effect in PNL, and 1920 anyways is correct. So that is how you will give effect to prior period errors. Okay, if suppose, just to extend this example, if 1617 was also an error, okay, here also instead of 120, okay, instead of 120 you have posted only 100. So here also there is an error. So here also I will adjust it in RE. So these 2 years I will adjust in RE, and this year I will adjust in my PNL. This is how I adjust for prior period errors. Ankur has a question. A business was purchased by private limited company to which Ind AS is applicable for the first time before 20 years. Goodwill in the books of partnership firm was also transferred to the company. Goodwill recorded as business valuation. Goodwill recorded as per business valuation report in books of the firm. No depreciation was charged till date on goodwill. What should be the treatment? So basically, Ankur, I will come to business combination separately because there is an exemption on business combination. Okay, if you choose to apply this exemption, I will not care about what accounting has been done in the past. I will assume that whatever balances are as on 1st April 18, okay, whatever be my opening balance sheet date, I will start with those balances. But yes, if there's an error done in the past, for example, you say that goodwill should be amortized, but goodwill was not being amortized, then I will first correct the error. I will bring it to the correct as per Indian GAAP. Okay, error as per Ind AS not. I'm saying if there was an error as per Indian GAAP itself, I will first those errors as per Indian GAAP, come up to the correct balances as per Indian GAAP, and then if I choose to not restate past balances, then whatever is the balances as per Indian GAAP is continued as balances as per Ind AS. If I choose to restate business combination, then I will forget whatever accounting has been done as per Indian GAAP. I will go back to the date of business combination, do accounting as per Ind AS. And that also means that we are assuming that you have all the information regarding fair valuation and everything which is required to do business combination accounting as per Ind AS. Okay, all the information should be available as of the date of business combination. So I will assume that all adjustments you had all the information, so adjustment will be made on the business combination date as per Ind AS, and then accounting as per Ind AS, and arrive today. So both the options are available. You can choose the easier option, which is assuming that Indian GAAP balances continue same, and hence that is what my opening balance as per Ind AS, same balances, or the harder option, the difficult one, which is you go back, restate as per Ind AS, do accounting as per Ind AS, and arrive at today's value. Both options are available. You can choose which option you want. Okay. Then there is a question from Vidya. Transition adjustments will be routed to retained earnings only. So Vidya, I will answer your question. I have a slide on this, but just because you have asked it, almost all, except couple of them, almost all adjustments will be routed through retained earnings. There are a couple of them which will be routed through other reserves or goodwill. For example, if you decide to restate business combination, the adjustment will be adjusted in goodwill. Okay, there might be other reserves also. So, there might be some adjustments which may be made in other reserves. So I will take up your question separately, but just to answer it, most of it in retained earnings. Sanjay has a question. Government grants earlier as per IGAP was transferred to capital reserve. Now while preparing opening balance sheet, there will be transferred from capital reserve to RE. So Sanjay, for government grant, okay, which was already done in capital reserve, okay, generally there is no guidance as such as to what needs to be done to reserves. Whether I can continue the reserves, whether I need to change it from one reserve to another. But definitely there is a guidance in the Companies Act about distributable reserves or free reserves. So while transferring your capital reserve to retained earnings, though there is no prohibition under Ind AS, but you need to be careful about your Companies Act. Once you transfer to RE, retained earnings, how will you differentiate between what is distributable and what is not distributable? Okay, so while transferring to RE, you should be really careful, where at least there is an option in Ind AS whether you need to continue in capital reserve or you need to transfer to RE. So be careful on that. Okay. Ankur has a question. Partnership firm purchase can be called as business combination. Yes, Ankur, purchase of partnership firm can be called as business combination provided there is a business in that partnership firm. I don't want to spend too much time on business combination standard, but business combination standard only applies if you purchase a business. That business can be part of partnership firm, that business can be part of company, that business can be anything, but it has to be a business. And when I say business, that means it has to have input, process, and capability to generate outputs. Just for example, there are a lot of real estate companies which own only land. So they have a lot of partnership firm which has only land. If I purchase a partnership firm which has only land, or even a company which has only land, okay, it is not a business combination. It will become business combination if that land is given on rent and there's a rent being collected, so you're making a business out of that land, then it's a business combination. Otherwise it's purely a purchase of an asset. So if the partnership firm has a business, then purchase of partnership firm is a business combination. Let's go back to the slides. Okay. So I was saying, consider whether you need to apply optional exemptions from retrospective application or not. Okay. Then mandatory exceptions are, like I said, mandatory in nature. You need to apply it. There is no option there. So you will have to apply them. Okay. So those are to be applied. And then finally, you make extensive disclosures to explain the transition to Ind AS. So there are a lot of disclosures required by this standard. It says that you give reconciliation. So what would have happened is, I'll go back to a few slides. Okay. Now, 1st April 15, which is 31st March 15, you would have balance sheet as per Indian GAAP. 15-16, you will have balance sheet as per Indian GAAP. 31st March 16, you will have balance sheet as per Indian GAAP, because 16-17 is the first year when you will be preparing Ind AS, right? So up till 31st March 16, you have Indian GAAP. So one of the disclosures which is required is 1st April 15, which is 31st March 15, you give a comparison or a reconciliation between equity as per Indian GAAP. When I say equity, it means equity, share capital, reserve, surplus, everything. Okay. So you give reconciliation between equity as per Indian GAAP and equity as per Ind AS. Similarly, on 31st March 16, you give reconciliation between equity as per Indian GAAP and equity as per Ind AS. For P&L of 15-16, you give a reconciliation between the profit as per Indian GAAP and profit as per Ind AS. So you need to reconcile equity and you need to reconcile profits. This is the requirement. If you would have seen some of the annual reports, most of the companies actually give complete balance sheet reconciliation line by line, every line item. Some of the companies give only equity. Some of the companies give balance sheet and P&L line by line reconciliation. So requirement is to give profit reconciliation and equity reconciliation. How much more details you give over and above the requirement is up to you. So extensive disclosures are required. Now this is for Vidya's question on where the adjustments will be made. So in opening balance sheet, okay, opening Ind AS balance sheet, the adjustments which are required to be made because of applying Ind AS, okay, most of them, like I was saying, 90% of them would be made in retained earnings. Some of them would be made in another equity category, like one of the questions of Sanjay was, can I transfer capital reserve to RE? So one of the adjustments might be made in capital reserve. Then there might be revaluation reserve. Okay, so revaluation reserve also you need to eliminate when you transition to Ind AS if you don't adopt uh, revaluation model, then revaluation reserve has to be made zero. So even that will be transferred to equity. Okay, so many reserves will be transferred to equity. So all other reserves will also have certain adjustments. So another equity category will have certain adjustments. And finally, there might be exemptions if you have chosen not to apply that exemption of business combination. Then there might be certain adjustments which you will make in goodwill. So I'll repeat: maximum adjustments in retained earnings, some adjustments in another equity category like reval reserve, capital reserve, some other reserves, FCTR also, foreign currency transition reserve. Okay, and in case of business combination, you might be required to make adjustment in goodwill. So this is how adjustments will be made in the opening balance sheet. Now here's the list of mandatory exceptions. There are 7 of them. Okay. And only 7 of them. Whereas if you see the list of exemptions, there's a long list, but for exceptions, it's only 7. We'll go through it one by one. Okay. I don't plan to cover all exemptions and exceptions. I will cover the important ones. Okay. The ones which are practical, practically you will be implementing them or you will be required to know. But we definitely cannot go through all of them. Okay. Okay. Sanjay has a question before that. Goodwill earlier amortized as per IGAP, now on date of transition adjustment to RE. So Sanjay, if you choose not to restate business combination, not to apply exemption relating to business combination, then whatever goodwill has been amortized is amortized. So it has gone to P&L and gone to RE already. Retained earnings it has already gone to. So that will be considered as gone. The closing balance of goodwill will be considered as new deemed cost or new carrying value of goodwill as per Ind AS. Okay. But like I said, if you choose to restate business combination, then you will recalculate goodwill. You will not do amortization. So those things will be reversed. Then the balance adjustment will be made in retained earnings. Okay. Let's take mandatory exceptions one by one. The first one, estimates. Okay. Now the basic principle of estimates is you have to assume that what would have been your estimate if you were standing on the date of transaction, what estimates you will make. Or if we talk about the opening balance sheet date, if you were on, say our opening balance sheet date is 1st April 18. So if you were at 1st April 18, what estimates had you made? Okay. You cannot take the benefit of the time which has elapsed. That means today I know how much warranty expense I have actually incurred, or which liability I've paid off, which liability I've reversed. So today I know all of it, right? But I cannot go back and use this knowledge which I've gained after 1st April 18 to estimate the amounts as on 1st April 18. Okay. So you cannot make use of hindsight. Okay. You cannot make use of hindsight. That is, any information that you have gained after 1st April 18 cannot be used to make estimates as on 1st April 18. So it's a mandatory exception that for estimates, okay, you cannot go back. It has to be prospective in nature. Manilal is saying, sorry, is voice cracking for all? Is it fine? Okay, thank you, thank you, thank you, Krishna. Okay. So let's read the slide. It says that an entity's estimates in accordance with Ind AS as at the date of transition shall be consistent with the estimates made on the same date in accordance with Indian GAAP, unless there was an error. So unless error, you cannot change your estimates. Okay, it will be prospective in nature. You cannot retrospectively change your estimates. You cannot make use of hindsight. If there was an error, definitely you need to go back and correct the error. But if there's no error, you cannot change it. Okay. So it says there can be multiple scenario. Okay. Scenario number 1 is you have not made an estimate at all on your opening balance sheet date because that estimate was not required as per Indian GAAP. For example, decommissioning liability. Okay. What is decommissioning liability? After 30 years, when I disassemble or stop my factory, okay, anything which I have made, harm to the ground, land, the forest, the water, or any such thing, I need to correct it. I need to plant new trees. I need to refill the land. I need to purify the water. These are examples of decommissioning liabilities. Now this will incur 30 years later, right? I need to estimate today what will be the cost required 30 years later, make a provision and adjust it in the cost of asset. This is as per the standard. Now, as per Indian GAAP, I was never required to make such an estimate. So I would have definitely not made this estimate on 1st April 18, which is my opening balance sheet date. At that time, I never knew that 2 years later I will be applying IndAS, so I should make an estimate. No, I did not know, so I never made that estimate. Okay, so if you have not made an estimate at all as per old GAAP, then you imagine yourself on 1st April 18, what estimate you would have made had you been on 1st April 18. Okay, so on the slide, if you see, was estimate required by previous GAAP? If you say no, then you need to make new estimate, but reflecting the conditions on the relevant date. Okay. Secondly, second scenario is estimate was required by Indian GAAP, but you made an error. If you made an error, then again you need to correct that error, make new estimate, but estimate should reflect the conditions existing on the relevant date. You should not take benefit of hindsight. If there was no error also, there can be a scenario that estimates are same, but use of the estimates is different. Okay, or application of the estimate is different. For example, warranty. My estimate on 1st April 18, as per Indian GAAP also I need to estimate. My estimate of on 1st April 18 was warranty cost might be incurred of 100 rupees and it might be incurred 50 rupees every year. So second year 50 rupees, third year 50 rupees. Okay. As per Ind AS, when you make such an estimate, you also need to discount because you will incur cost second year and third year. So you need to discount 50 rupees for 2 years and 50 rupees for 3 years. Okay. So estimates will remain same, but application of estimates, probabilities, discounting, those things might be little different. So if calculation is consistent with Ind AS, then you use the same calculation, same estimate. If it is not consistent with Ind AS, then estimate you use previous ones, but you adjust it to reflect the requirements of Ind AS. Okay. So that's the requirement of estimates. There are 3 questions on the slide. Okay. I want you to go through these questions and then we will discuss. So I will allow you say 2 minutes, go through each question and then we'll discuss. Okay. So after all 3 questions you have gone through, we'll discuss all 3 of them. I'll give you 2-3 minutes. Okay, if you have gone through all the questions, okay, let's discuss now. So the first one, okay, first one, it says that after a year or two, you realize that the provision which you created is not enough because there was a design defect. Okay, now this is not an error, this is a new information which you came to know a year or two later, so you cannot go back and adjust the estimates. So in the question one, you will not go back and change your estimates, you will continue to use the same estimates. Let's go to the second question. In the second one, it was an error, clear error, because the estimates were done basis the basic salary and not basis the basic salary plus special allowance. So it was a clear error. Since it's an error, you will go back and revise your estimates. Okay. The third one, in the third one, again, there was a new information, which was that you now feel that you will be required to pay 3 lakhs. Since it's a new information or because of the development, your estimates have changed. Change in estimate is always prospective. Hence, in third question also, you will not go back and revise your estimates. You will continue with the same estimates. Okay. Let's go to the next slide. I hope it's clear. If any questions, please feel free to ask. Otherwise, I'll go to the next question, next slide. Okay. This is your okay, there's a question from Vidya. In the first question, when will we bring additional estimates? So in the year in which you change the estimate, which is in 11-12. So in 2011-12, the company came to know that products had design defect. So in 2011-12, you will change your estimates and book additional expense for those additional provision. Okay. So second mandatory exception is non-derivative financial instruments derecognition. Okay. Now this is say for example, you have debtors. That debtors you go and discount with a bank. Okay, you have trade receivables debtors which you go and discount with a bank. Now generally these discounting is with recourse. With recourse means if the debtor does not pay on the due date, then you will be required to repay the money back to the bank. Okay, I'll repeat. Generally, if you discount your debtors, it is generally with recourse. With recourse means if the debtor does not pay the money on time, okay, then you need to pay the money back to the bank. Okay, if it is with recourse, then you will need to recognize a liability. Okay, you cannot de-recognize the debtors. Let me take you to Excel to explain this better. Okay. Uh, okay. So what I was saying is, suppose I have debtors of say 100. Okay. Now I go and discount it with a bank. So bank pays me say 95. Okay. 5 rupees is discounting charges. Discounting charges 5 rupees. Now this 5 rupees has come to my bank. Okay. What is the journal entry which I am required to do? The journal entry will be bank debit 95, bank charges debit, or bank charges is expense, bank expense debit, let me say 5. To liability 100. Okay. This 5 actually will first be prepaid expense kind of thing. Let me stop the video. Somehow video takes a lot of bandwidth and hence there is cracking. I hope it is better now. Is it better? Yeah, thank you. Thank you so much. Okay. So I was saying bank debit 95, expense debit 5. Now this expense will be prepaid expense which will be amortized over the period of discounting. Generally 3-4 months, 6 months. Okay. So this will be amortized to liability 100. Okay. Now what is my net effect? Net effect is I have debtors 100. Okay. And I have liability 100. Okay. I have bank 95. Okay. And I have prepaid expense 5. This is how my effect will be in the balance sheet and P&L. Okay. Now in Indian GAAP, many companies used to de-recognize these debtors. Instead of recognizing a liability, they used to de-recognize the debtors. So that means these two will be not there. I will simply have a bank of 95 and a prepaid expense of 5. Okay. That means they have de-recognized this debtor. Now this is not correct as per Ind AS, but Indian GAAP, because of lack of guidance or lack of clear guidance to say so, many companies might have done this. So let me go back to the slide. Here it says that if something has been, okay, Asif, I will explain again. I have just explained the transaction. Okay, I have not explained the accounting as such or the impact as such, but I'll again explain. So I was saying that suppose I have debtors. Okay, if I have debtors of 100 and I go to a bank and discount at 100. Why is this tracking again? Hello, is this any better? Is this fine now? Okay.
Yes, but still cracking a bit.
Okay. Let me try again. Okay. Is this? I hope this is better now. Now it's clear.
Yes, yes, yes.
Yes. Okay. Sorry for this disturbance. Okay. I was saying that suppose I have debtors of 100 and I go to a bank and discount this 100. Okay. Bank gives me money immediately and debtor will pay to the bank. This is the transaction. So debtor, instead of paying to me, will pay directly to the bank. Bank gives me money immediately. Okay. So basically, instead of waiting for the credit period of 3 months to end, okay, I get money immediately, and this 5 rupees is interest for that 3 months credit period. So I get 95 immediately. 5 rupees is like interest for 3 months, and the debtor will pay 100 at the end of 3 months uh, to the bank. Either it will pay to me, I will pay to the bank, or it will directly pay to the bank. So that is basically simple way. It may be different operationally, it may be little different, but that's a principal transaction. Okay. Now generally these kind of transactions are with recourse. I was saying with recourse means if the debtor fails to pay on time, on the due date, if the debtor fails to pay, then I will be required to return the money to the bank. Okay, I will be required to repay that money to the bank. If I am required to repay the money to the bank, I should not be de-recognizing my debtors. Instead, I should be recognizing a liability. Okay. So instead of de-recognizing the debtor, I should be recognizing a liability. So I was saying my accounting entry should be bank account debit, prepaid expense account debit to liability. Okay. bank account 95, prepaid expense 5, and liability credit 100. This should be my journal entry. And after that journal entry, okay, this is the journal entry I have mentioned, bank debit, okay, expense debit to liability. After this, sorry, I'm trying my best, but I don't know, maybe temporary, hoping that this disturbance will go away. Yeah, sorry for this, but I really am helpless right now. I've tried all possible things. so I was saying that bank debit 95, prepaid expense 5, and liability 100. This is the journal entry I should be posting. Okay, and this is the effect after that journal entry. What some companies do, so this is suppose as per Ind AS, okay, correct accounting. What some companies do in Indian GAAP, I am not saying all, but some of them, depending upon the interpretation and the guidance, what companies do is bank debit, prepaid debit, this is 95, this is 5. So here there is not much choice or not much play, but here they do two debtors. So instead of recognizing a liability, they credit debtors. Okay, so in essence they have de-recognized debtors. The effect of this is I have these two entries on my balance sheet and P&L. My debtor and credit, my debtor and liability is gone. I have bank and prepaid. Okay, this is the transaction which has happened under Indian GAAP. Now what do we do in my opening balance sheet? Okay, what do I do in my opening balance sheet? So let's go back to the slide. Okay, as per IndAS 101, the derecognition criteria as per IndAS 109 needs to be applied prospectively. That means I don't have to go back and correct the accounting which I have done in my Indian GAAP in the past. If I have derecognized the debtors, let it be derecognized. You need not recognize the debtors and the liability in your books again. Okay, so it's a major relief for the first time only. Okay, only for the opening balance sheet date, you are allowed not to retrospectively apply the derecognition guidance. So you can, if you have already removed debtors from your balance sheet and not recognized the liability, it is okay for that transaction. We will ignore that transaction and go ahead under Ind AS. Okay, I hope this is clear. So under Ind AS, I am not required to make any adjustments for the derecognition which you have done in the past. Okay. Let's go to the next one. In fact, before going to the hedge accounting, we can take a 5-minute break now. And then after 5 minutes, we continue with the standard. Okay, so it's 12:30, 12:29 in my clock, almost like 12:30. Let's come back at 12:35.
Krishna, we have a break.
Yes, sir.
How much time?
10 minutes.
12:40, na?
Yeah.
Yeah, please start.
Okay, thank you. So we have done two exceptions till now. These are mandatory ones. The first one which we did was estimates, where we said that estimates we cannot use hindsight and we'll have to do it prospectively. Second one we did was derecognition. The example which I gave was discounting of debtors, where I said that if you have already derecognized your debtors, then we will apply the requirements prospectively and we will not bring back those debtors on your books. Okay. Now the third one is hedge accounting. Now this is a little tricky one because hedge accounting in itself is difficult. I will try and simplify as much as possible. Now, what was the accounting we used to do for hedge transactions under Indian GAAP? Indian GAAP mostly did not have much of guidance on hedge accounting. There's a derivative guidance note on derivatives which gives certain guidances, but those are mostly optional, and many of the companies never did any hedge accounting under Indian GAAP. Now, under Ind AS, there are two types of hedge: cash flow hedge and fair value hedge. Cash flow hedge is where your cash flow is at risk. So, for example, if you have a floating rate of interest loan, every month your interest cash flow will be different. Okay, depending upon, so it may not be every month, it may be reset every 3 months or every 6 months. But whenever your interest rate is reset, your cash flow will change, keep changing, right? So there's a risk to your cash flows. So then you can enter into a derivative transaction wherein you swap your floating rate of interest with fixed rate of interest. You convert your floating rate of interest loan to fixed rate of interest loan. So that's called a cash flow hedge. In cash flow hedge, you basically, you fair value the derivatives and take it to cash flow hedge reserve through OCI. Then there is a fair value hedge reserve, fair value hedge transaction. Fair value hedge is where your fair value is at risk. For example, if you already have a fixed rate of interest loan, suppose my rate of interest is 10% right now. Okay. Now, if my rate of interest is 10%, a fixed rate of interest loan, what will happen is if currently in COVID scenario, what is happening is the interest rates are going down. Okay. The home loans are currently at say 7%, 7.5%, approximately that. But I have taken a loan which is long back, fixed rate of interest 10%. Okay. So I am paying say on 100 rupees, I am paying 10 rupees as interest. If my loan would have been taken today or was floating, I would have paid interest rate of only say 7%. That means I could have borrowed 150 rupees, okay, and would have paid the same interest of 10 rupees. So on loan of 150 rupees, today I could have paid 10 rupees, but because my rate of interest is fixed rate of interest, I am paying 10 rupees on 100 rupees loan, right? So there's a fair value risk. My interest rate is flat, okay, there is no cash flow risk, but the risk is of fair value. And hence, if I convert my fixed rate of interest loan to floating rate of interest loan, I can shift, remove. There's some problem today. Generally, I don't face such issues, but some problem today. I've not opened up any this also, any internet consuming applications or anything. Everything is shut, but still somehow I hope things are better now. It's not a mic issue. It's not a mic issue, I think. It is internet only. Is it any better? No. Okay. Is it better now? Okay, fine. Chalo, ठीक है. Okay, so I was saying fair value hedge. So for the same 10 rupees interest, I could have borrowed 150 rupees today. But since I have a fixed rate of interest loan, I am stuck with borrowing of 100 and interest of 10. Okay. So see, it's not a cash flow risk, right? Because I know every month I have to pay 10 rupees as interest and the principal, whatever the principal amount I have to repay. So there's no cash flow which is changing. What is changing is fair value of the loan. Okay. So if I convert from fixed rate of interest to floating rate of interest, it will be called a fair value hedge. In fair value hedge, I fair value the derivative, okay, and fair value the derivative and the loan both, and both goes to the P&L. Okay. So that's how fair value hedge and cash flow hedge works. I have explained it in very summarized manner, very quick manner. Although there is a lot of details, we can keep on discussing hedge accounting for a long time. Now, under Indian GAAP, what we do is we don't do hedge accounting, but we do derivative accounting. How do we account for derivative is we account for the premium which I have paid, which is the future price minus the spot price. Okay, so if I'm talking about the currency derivative, the spot rate compared to the future rate, the forward rate, that is what I call as premium. And the premium is what I amortize over the period of the derivative. So if derivative is for 3 months, I amortize the premium over 3 months. This is the accounting I've been doing under Indian GAAP. Okay. Now this accounting I would have done till say 31st March 19, assuming that 1920 is my first year of IndAS, I would have done this accounting till 31st March 19. What this standard says is, if you have not done hedge accounting under Indian GAAP, okay, then you are not allowed to do hedge accounting for past periods. Hedge accounting can only be done for future periods prospectively. Again, here the matter is of hindsight. See, hedge accounting, what it does is it allows me to park the gain or loss on the derivative in my cash flow hedge reserve. Okay. Now, what companies generally do is if there's a gain, they prefer it in P&L. If there's a loss, they prefer it in reserves, right? Now, I cannot do this accounting after 2 years, because at the end of 2 years, I know whether there's been gain or loss. If there's a loss, I will say it is hedge accounting. If there's a gain, I will say no hedge accounting. So I cannot pick and choose, right? So hence it says that you cannot take benefit of hindsight. You do prospectively. So you do from today onwards. You don't touch the past. Okay. So what you have done if under Indian GAAP, you have not done hedge accounting, you cannot touch the past. Hedge accounting you will do only for future. If in Indian GAAP you have done hedge accounting, which is allowed under Ind AS also, okay, then you only adjust for the difference between Ind AS and Indian GAAP, which might be a little bit, and then continue. So that is what the standard says. Okay, so it says that at the date of transition to Ind AS, you measure all derivatives at fair value, eliminate all the amortization of premia, which the accounting which I was doing, eliminate all that accounting. Okay, all derivatives need to be measured at fair value. And if you were doing hedge accounting under previous GAAP, which is allowed as per Ind AS, then you continue. If it is not allowed as per Ind AS, then you de-recognize that hedge accounting also. Okay. In short, hedge accounting as per Ind AS prospectively, and if it is derivative, then instead of doing your premium accounting, you de-recognize the premium accounting and do MTM accounting, which is mark to market or fair value accounting. Is this clear, or anyone has any questions on hedge accounting or this slide? Any questions on this slide? Okay, if there's no question, I'll move to the next slide. Non-controlling interest. Okay, now there are a couple of things which happen, okay, in non-controlling interest, which is different from Indian GAAP. Okay, now Indian GAAP, there's a thing that minority interest can maximum be 0. You cannot allocate loss to minority interest beyond 0. That means minority interest cannot become negative. It cannot become asset for you. It can be 0 or positive liability. It cannot be negative liability. Okay. However, under Ind AS, non-controlling interest can be negative also. That means you will keep on allocating losses to non-controlling interest even if it goes into negative, even if it becomes a asset as such. A negative liability means asset as such. You continue to allocate losses to non-controlling interest. Okay, that is one big difference. Then there is another difference, which is sometimes what happens is you sell certain shares, but you do not lose control. For example, if I own 90% of my subsidiary, okay, for getting some funds, okay, I am in need of some funds, I sell 5% of my subsidiary shares. So from 90% I come down to 85%. But it will still remain my subsidiary because I still have 85% voting rights. Okay, so standard says the standard on consolidation, it says that any change in the shareholding which does not affect your control relationship, that means subsidiary still remains subsidiary. 90 can become 95 or 90 can become 85 irrespective, but subsidiary at 90 also it's subsidiary, 95 also subsidiary, 85 also subsidiary. So subsidiary remains subsidiary, only you have sold some of the shares or you have purchased some new shares. Okay, in that case you cannot book any profit or loss in P&L. The profit and loss will be parked in one of the reserves. Any profit or loss which you make in this transaction, for example, I was holding 90% shares at rupees 100 per share. Okay, 5% of the shares I sell at today's value, which is 160 per share. So on 5% shares I make 60 rupees per share profit. Okay, this profit I am not allowed to take into P&L. I will have to keep this profit parked in a reserve in my consolidated financial statements. Okay, under Indian GAAP I would have taken it to P&L. So there are some differences in measurement of non-controlling interest between Indian GAAP and IndAS. This slide says that it is connected with your slide on business combination. Okay, if in business combination you decide that you will not go back, then for NCI measurement also it says that do not go back, do it prospectively. That means if you have not allocated losses, forget it. If you have already booked profits in P&L, fine, book it. Okay, however, if you decide to go back for business combination, you decide that I will go back 5 years, 2015 onwards, all business combination I will restate, then for non-controlling interest also you will have to go back to the same date, which is 2015, and recalculate your non-controlling interest from that date onwards. So basically it is saying that Ind AS 103, which is on business combination, and Ind AS 110, which is on consolidation, will go hand in hand. Whatever option you select for business combination, same option will apply for consolidation. Okay, if you go back for business combination, you have to go back for consolidation. If you don't go back for business combination, no need to go back for consolidation. Two major differences I explained in consolidation, essentially non-controlling interest. One is losses. You don't attribute losses to non-controlling interest beyond zero under Indian GAAP. In India, you go negative also. Second difference I explained, wherein you change the percentage holding without affecting the subsidiary relationship. Okay, then the profit or loss on the transaction is not taken to P&L, it is parked in reserves. So these two changes or differences between Indian GAAP and Ind AS you will ignore. If you apply prospectively to business combination, then you apply prospectively to non-controlling interest measurement also. Okay, is this clear? Any questions on this slide? Okay, then let's go ahead to the next slide. Okay, this is on classification and measurement of financial assets. Okay, now financial assets, you know, there are three classifications. Okay, can someone help me with the three classifications of financial assets? What are the three classifications of financial assets? Amortized cost, yes, right. Hold till maturity is not there, Bhakti. It's old standard. Now you don't have HTM. Yes, Sagar is right. Amortized cost, FVTPL and FVOCI. So absolutely right. These are the three classifications as per IndAS 109 of financial assets. Now this classification of financial asset into amortized cost, FVTPL and FVOCI, this depends upon the SPPI test. What is SPPI test? What is full form of SPPI? It is also called as cash flow characteristic test. Cash flow characteristic test or SPPI test. Full form of SPPI? Yes. P and I is principal and interest. Solely payment of principal and interest. Okay. It is not purpose. The P should be is payment. Solely payment of principal and interest. So to decide whether a financial asset will be classified as amortized cost, FVTPL or FVOCI, you have to go through two tests. The first test is SPPI test, which is solely payment of principal and interest. That means you have to see whether it will purely give you only principal and interest, or will it give you something else. Okay. For example, equity shares will give you profit. It will not give you principal and interest. A FD with a bank will give you principal and interest. A debtor will give you principal and interest. But if I have invested in debentures, which are listed debentures, okay, it might give me principal and interest, but it is also listed, so it can give me more also. Okay. So you have to decide whether it fulfills the criteria of SPPI or not. And the second test is business model test. Business model test is basically what I expect from this, whether I will sell it, whether I will continue to hold, okay, whether I want to trade in it. So there can be different business objectives of holding the investment. Okay. So depending upon these two tests, which is business model test and SPPI test, you decide whether the financial asset will be classified as amortized cost, FVTPL or FVOCI. Now, when do you decide this? You decide this when you entered into the transaction. You might have entered into the transaction 5 years ago, 10 years ago, depending upon what kind of transaction it is, or which line item it is, or which instrument it is. Okay. It is difficult to go back 5 years, 10 years and see what intention you had, whether at that time your business model was to hold, or at that time your business model was to sell, or your business model was to trade. Your business model keeps changing. Okay. It can change every 3-4 years depending upon your intentions, your business case scenarios and all that stuff. So this standard says that you need not go back on the date of transition. Okay. On the date of transition, which is say 1st April 18 in our example, on 1st April 18 you decide whether it fulfills the SPPI test, whether it fulfills the business model test, and depending upon the fulfillment of this test, you decide the classification and measurement of your financial asset, whether it will be amortized cost, FVTPL or FVOCI. Is this clear, or are there any questions on this slide? Okay, let's go to the next slide then. Embedded derivatives, again financial instrument and complicated one. Okay, embedded derivatives basically means there can be certain derivatives which are embedded in a normal purchase sale contract. For example, you in the malls, when you take shops on rent, the rent is generally there's some part which is fixed and some part which is linked to your sales. Okay, so say for example 1 lakh fixed rent plus 10% of your sales, 10% of your top line. So rent is mixture of fixed plus linked to your sales. This is an embedded derivative. Okay, your loan from bank has a prepayment option. You can prepay the loan. That prepayment option is an embedded derivative. Your insurance contract has an option to surrender. Okay, you can stop paying premium and you will get some of the premium back which you have paid in the past. That is the surrender option. That surrender option is a embedded derivative. Okay, if you enter into a transaction with a person from a different country, for example, I entered into a transaction from with a company which is based out of Dubai, and I enter into that transaction which is denominated in yen. So I am in India, my currency is INR. The transaction I have entered into is a company from Dubai. Okay, their currency is dirhams, but our contract is in yen. This is an embedded derivative transaction. Okay, so there are a lot of such transactions. I can keep giving examples where there is some derivative which is embedded in the contract, okay, which makes the value of the contract variable. Okay, in such case, IFRS 9 requires you to separate the derivative, account for derivative separately, and account for base contract separately. So normal lease accounting you do, and for the derivative you fair value the derivative. Okay, and this is required to be done irrespective, okay, whether you adopt IFRS 9 on 1st April 18, irrespective of that, you are required to do retrospectively. Okay, only relief that the standard gives to you is if the contract has changed, there is some amendment in the contract, then you do this from the date of the amendment. You do not go back to the original date of contract, you do it from the date when the contract is amended. If the contract is not amended, then you go back to the original date of the contract. There is no relief in embedded derivative accounting. Okay, so very restricted relief has been given. That restricted relief is if the contract is amended in the past, you start from the date of amendment. If contract is not amended, you start from the date of the contract. No other relief given regarding accounting for embedded derivative. Okay, so embedded derivative accounting you have to do retrospectively only. Last mandatory exception is government loans. Okay, government loans, let's take an example, export incentive, or rather than export incentive, let me take an example of sales tax deferral loan. Okay, sales tax deferral loan was very common in Maharashtra also. Many companies had availed the sales tax deferral loan. The concept was sales tax deferral loan. The concept was that if I have a VAT or sales tax payable of say 100 rupees today, okay, today is say suppose let's go back to the year 2000. So in the year 2000 I had to pay 100 rupees as sales tax. Government allowed me to carry this 100 rupees liability for 10 years. Okay, so for 10 years I don't have to pay anything to the government. After 10 years I have to pay 20 rupees each year for the next 5 years. So from the 11th year to 15th year I pay 20 rupees each. Okay, so that's how I pay totally 100 rupees. So I'll repeat, the transaction was I have to pay 100 rupees today, which is in year 2000. From the year 2001 to 2010, I don't pay anything to the government. From the year 2011 till 2015, I pay 20 rupees each year to the government. That is what sales tax deferral loan was. Now under Indian GAAP, I did no special accounting. Simply I carried the liability in my balance sheet for 15 years. Last 5 years, I kept on paying 20 rupees each, and that's how the simple accounting was. Okay, under Ind AS, had this transaction been under Ind AS, I would have been required to do discounting and book interest expense. So government has given like a government grant to me by not charging me interest expense. Okay, so I will now be required as per Ind AS to account for interest, although I will not be paying to the government, but I account for interest expense, and then I account for government grant income. Okay, so that's government grant accounting to be done. That's normal. But under this standard, there is an exception given that you can follow Ind AS 109 for government loans prospectively. That means for the loans given in the past, you need not do such accounting. You are exempted from doing such accounting. what accounting you were doing under Indian GAAP. For past transactions, you can continue that accounting. So pretty simple. You need not do this complicated accounting for the past transactions. If there is any new such transaction, then you will have to do the accounting which I mentioned. Okay. Is this clear? Any questions on this slide? Priya has a question on impairment of financial asset. Priya, regarding impairment of financial asset, ECL, basically when you say, there is some exemption or exception regarding ECL, wherein it says that you need not go to pass. I don't know where it is. Either I have, there is Priya, you're right. There was some ECL related thing wherein, because in the past you were uh, uh, basically that said that for the past whatever happened in the past, you never calculated ECL as per Indian GAAP, right? So ECL is a new concept which you have to apply now. So it said that you need not compare whether your credit risk has gone up significantly for the past. You start afresh from the date of opening balance sheet. Okay, so that I think is still there. Maybe I have not mentioned it here, but is still there somewhere. Okay, it's there. I can tell you that it's there. Okay. Okay, let's see the optional exemptions. These are the list of optional exemptions. Like I was saying, I will not cover all of them. There is not enough time to cover all of them. I will cover a few of the important ones. Okay, let's start with business combination. Now, business combination, let's go to Excel and see what's the transaction and how to do accounting. Okay, suppose in my past I have had 5 business combinations. Okay, one in 2010, one in 2012, one in 2015, one in 2016, one in 2018. These are the 5 business combinations. Okay, let me say 2017 here, because 2018 onwards I am implementing Ind AS any which ways. So there are 5 business combinations. Okay, now I have an option to select a date, and any business combination after that date, okay, I will restate as per Ind AS. Now what date can I select? I can say that suppose 15, 16, 17, these are the business combinations that I will restate. These 2 I will not restate. Or I can say that I will restate these 4. The first one I will not restate. Okay. Or I can say that I will restate only these 2. The first 3 I will not restate. Or I will say that I will not restate any of them. Okay, I will not restate any of them. I will do it prospectively. So I have option. However, I don't have option that I will restate this, not this, but this, not this, but this, not this. So I cannot do selective, selectively I cannot select that which business combination I will restate, which I will not restate. I have to select a year, and all business combination after that year I will have to restate. If I restate business combination, I will have to do the entire purchase price allocation accounting. I need to fair value the assets. I need to calculate goodwill, negative goodwill, non-controlling interest. And like I said sometime back, even your consolidation standard will be retrospectively followed from that date. Okay. So these are the impact of selecting a past date. Generally, if there is no special benefit that you derive out of restatement, then it is not suggested to restate past business combination. You should follow it prospectively only. You should not restate your past business combinations. Okay. Any questions on this? Is this clear? I'll go back to the slide. So here it says that you have to choose a date of your choice and apply Ind AS prospectively from that date. You have to select a date, and from that date, all business combinations will be restated. And then you will have to adjust. If you restate your past business combinations, you will also have to adjust your goodwill. Okay. Any questions? Shall I move to the next slide? Is it clear? Okay. Let's go to the next slide. Okay, this is interesting. Property, plant and equipment. I'll take you back to the Excel. Okay. Now, what are the options that I have for fixed assets? Option number one is I can remeasure the cost as per Ind AS. Option number two, I can fair value on the date of transition. Option number three, past revaluation. If I've done revaluation in the past, then I can choose that revaluation and from that date onwards apply depreciation as per Ind AS. Finally, we found a reason why voice cracks, huh? When I use Excel, voice crack. Anyways, so I am anyways typing as much as possible on Excel so that even if you're not able to hear me clearly, at least you can read clearly on the screen. So I have options. Okay. Option number one, remeasure cost as per Ind AS. Option number two, fair value on the date of transition. Option number three, if I have done past evaluation, I can take that and from that date I can apply depreciation as per Ind AS. Okay. Now these options can be applied, okay, to each item of PP. Each item means furniture one, which is say chair. Furniture two is table. Okay. Furniture three is say something else. Okay. So likewise each furniture, then plant and machinery one. Okay, one, two. So each plant and machinery I can apply different option. So here chair I choose option number one. Okay. Table I choose option number two. Okay. Plant and machinery one I choose option number three. Plant and machinery two I choose option number four. Oh, there's no fourth option. Sorry, third. So I choose one. I choose three. I choose one. So okay. I'm going back to the slide so that maybe you hear now clearly. What I was trying to say, okay, there's a question from Vidya, what's the difference between option number one and two? So Vidya, option number one is remeasurement of cost. When I say remeasurement of cost, you go back to the date when you acquired the fixed asset, you recalculate the cost, you add decommissioning liability, component accounting, useful life depreciation, all of the adjustments you do from the date when you first acquired the asset and come up to today's carrying value as per Ind AS. Okay, that is option number one. Option number two is simply you do fair valuation today. I go to a valuer, I get it fair value. Very simple. Okay, that's option number two. So that's the difference between one and two. So it says that I can select which item I need to apply which option. I can apply option number one to one chair, option number two to another chair, option number three to the third chair. So every chair different option. Practically it will not happen. Theoretically I am saying naturally no one will do this different option to different chairs, but theoretically yes, you can do it. Now Ind AS has a fourth option which is not there in IFRS. So IFRS has all the three options which I mentioned, but Ind AS has a fourth option. That fourth option is whatever is the carrying value as per Indian GAAP on 1st April 18, 31st March 18, okay, will be taken as the deemed cost as per Ind AS on 1st of April 18. So 31st March 18 as per Indian GAAP becomes deemed cost as per Ind AS on 1st April 18. Simple, no adjustment, simple, you take cost, carrying value as cost. Okay, so that's an option available only under Ind AS. It is not available under IFRS. However, if you choose the fourth option, then all property, plant and equipment, you can only choose the fourth option. You cannot choose option number 1, 2 or 3 for any asset. I repeat, if you choose option number 4, option number 4 will be applied to all the assets. Yeah, I stopped speaking. I'm making some adjustment. I hope it is better now. So I was saying that if you choose option number 4, which is carrying value is equal to option number 4, which is only available under IndAS, then all your assets will be applied the fourth option only. You cannot pick and choose option 1, 2 and 3 for any of the assets. Is this clear? Any questions on this? Okay, same 4 options is also available for intangible assets. Same 4 options are also available for investment property. However, investment property, the fair value option is not available. You cannot fair value investment properties. Okay, there's a question, will it affect the classification as MSME? I don't think so. I am not aware this. I don't think normally it should affect, sir, I don't think it should affect your MSME classification. I think it is based on the cost of investment rather than fair valuation. So it should go by that. I don't think it should affect. Okay, although I am not an expert on this question, so I'm not too sure. I have never come across this question. So these are the options available for your fixed assets, intangibles, and investment properties. Let's go to the next slide. Now this is your FCTR, foreign currency translation reserve. Okay. Now foreign currency translation reserve is created when you have a non-integral subsidiary. Okay, non-integral subsidiary, associate, joint venture, foreign operations. If you have any non-integral. Okay, can anyone explain me what is non-integral foreign operations? Okay. Can anyone type on the chat box what is non-integral foreign operation? As per your AS11. Okay, no issues. So non-integral is where the subsidiary is independent. It is not dependent on the parent. So it is independent subsidiary, that is called as non-integral subsidiary. In case of non-integral subsidiaries, what happens is they prepare balance sheet in their own currency. So I have a subsidiary in London. So it will prepare balance sheet in its own functional currency, in its own currency, local currency. Okay, say euro. It will prepare euro balance sheet. Then I will convert that euro balance sheet into INR balance sheet. Okay, and when I do so, my asset liability will be based on closing rate, exchange rate. My PNL will be based on average exchange rate, and the difference will be taken to FCTR. My equity will be at historical rates, and my difference will be taken to foreign currency translation reserve. Now the standard requires that you identify foreign currency translation reserve by each subsidiary. So every subsidiary should have their own foreign currency translation reserve. I should not mix up the foreign currency translation reserve of 5 subsidiaries. You know, if I have 5 subsidiaries, each one, I don't mix up. If I mix up, what will happen is the day when I sell one of the subsidiaries, I am required to transfer the FCTR relating to that subsidiary into PNL. Okay, so if I have subsidiary A, B, C, D, E, 5 subsidiaries, if I sell subsidiary D, then FCTR relating to subsidiary D will go to PNL. Okay, hence the balance of FCTR which I have in my balance sheet, I should be able to recognize whether that how much relates to A, how much to B, how much to C, how much to D, how much to E. Now many companies do not have such records. Okay, they have not maintained subsidiary wise FCTR records. Since they have not maintained subsidiary wise FCTR record, IFRS 1, Ind AS 101 gives a one-time relief. Okay, one-time relief, it says that you make FCTR 0. Transfer your FCTR to your retained earnings. Okay. And from now on, you track your FCTR subsidiary wise. So the option basically is you can convert your FCTR into 0 or revise your FCTR to 0 and transfer the FCTR to retained earnings. That's the option available as per Ind AS 101. Is this clear? Any questions on this? Okay, then let's go to the next slide. Okay, now investment in subsidiaries, joint ventures and associates. What is the benefit? Vidya, the benefit is only that, like I said, if you do not have records that how much FCTR relates to which subsidiary, then how will you account for it in future when you sell one subsidiary? Okay, you will not be able to take that to P&L. So your FCTR balance will keep on continuing and the accounting will be not correct. So basically it is wiping off the past. It is saying start with 0 and now maintain subsidiary wise FCTR. So that's the only benefit, that at least in future you will do things correctly. Both will be part of reserves, you are right. Both will be part of reserves. FCTR is also a reserve. Retained earnings definitely is a reserve. Okay, but like I said, if you sell a subsidiary, FCTR will be reclassified through OCI to PNL. It will go back to PNL if you sell a subsidiary. It will go to your income statement. Okay, so you have to know how much FCTR relates to each subsidiary. Yeah, it's for aligning your accounts and ensuring that in future you don't, one time clean slate can kind of. Okay, investment in subsidiary, JV and associates. Okay, you have basically 3 options given. Okay, how to measure your investment in subsidiary, associate and JV. Okay, this option is only available for the first time, which is Ind AS 101. After that you apply your normal standards. So for the first time you have 3 options. Option number 1 is you recalculate the cost as per Ind AS. How is cost different of investment as per Ind AS and Indian GAAP? Okay, Ind AS, the cost will include, say, transaction cost, the cost of purchasing your shares. In Indian GAAP, you would have taken that cost maybe to PNL, maybe somewhere else. So cost generally is same, but some adjustments if you have made in Indian GAAP, then we don't know. So you recalculate the cost as per Ind AS. Option number 2, you fair value the investment in subsidiary today. Okay, for calculating the deemed cost, you fair value the investment in subsidiary. And option number 3 is whatever the value is coming as per your Indian GAAP, the carrying value of investment in subsidiary will be considered as deemed cost for Ind AS purpose. I'll repeat 3 options. You remeasure the cost as per Ind AS, you fair value on the date of transition, or whatever is the carrying value as per Indian GAAP becomes cost as per Ind AS. Very simple. Any questions if you have, then I can answer, otherwise I'll move ahead. Compound financial instruments. Now, compound financial instruments are instruments where you have both debt and equity. Okay, so if you have both debt and equity, for example, foreign currency convertible bonds. What happens in foreign currency convertible bonds? In foreign currency convertible bonds, the holder of the bonds, the investor, has option either to ask for the money back at the end of the tenure, either redeem the bonds for cash or convert the bonds into equity. Okay, this kind of instrument, company does not know whether the investor will ask for money or will ask for shares. If the investor asks for money, it is a liability. If investor asks for shares, it is equity. But investor will ask for money or cash only after 3 years. So today I don't know whether they will ask money or they will ask shares. Since I don't know today what will happen, how do I classify them? Should I classify them debt or should I classify them as equity? Okay. So since it has features of both debt and equity, this kind of instrument is called as compound financial instrument. In case of compound financial instrument, IFRS 9 requires, financial instrument standard requires me to discount the liability. So first of all, you have to assume that everyone will redeem. That's the assumption. Everyone will redeem. Then you discount it. Okay. The discounted value becomes the liability, and the balance amount, the residual portion, will be equity. This is the accounting you are required to do for compound financial instrument. Discount the liability and account it for as liability. Discount the redemption amount and account it as liability. Residual portion, account it as equity. Okay. Now here also you will apply this retrospectively. Very small restricted relief has been given by this standard. It says that if the redemption option is no longer outstanding, that means redemption option is gone. Now the investor or the remaining investors are only left with option to convert. Okay, they cannot redeem. That option is lapsed. Only in that scenario, you consider the entire instrument as an equity and don't separate the liability and equity component. Assume that entire instrument is an equity and take everything to equity. Okay, I repeat, it says that you need not separate into equity and liability components if the liability component is no longer outstanding. So redemption option is lapsed. If redemption option is lapsed, that means investors are left with no option but to convert into equity shares. In that scenario, you assume everything is equity and carry forward your accounting. If redemption option is not lapsed, then you have to retrospectively account as per compound financial instrument accounting given by financial instrument standard. I hope there is no questions on this. It is clear. If there is question, please feel free to ask again. Okay. Then next is designation of previously recognized financial instrument. Okay. Here it says that, see, there are some financial instrument wherein you are allowed to designate it as FVTPL only on initial recognition. Similarly, equity instrument, you are allowed to classify as an option to FVOCI only on initial recognition. These things are not allowed to be classified as such after the initial recognition, which is on the date of the transaction. You can classify them as FVTPL or FVOCI. After that, you cannot classify them. Okay. However, IndAS 101 as a relief says that you can decide this designation on the date of transition. So on the date of transition, such instruments you can classify as FVTPL or FVOCI on the date of transition, depending upon the circumstances existing on that date. Now, I just want to draw differentiation between the normal instruments and the instrument which I am talking about in this slide. These are not normal instruments. The first para talks about a rare kind of instrument where there is liability and asset and both are linked. Okay. Say asset is already fair value as per normal IFRS, but liability is at amortized cost. Then you are allowed to change the classification of liability to FVTPL. It can be reverse also, that liability is FVTPL and asset is amortized cost. Then you can reverse the classification of asset to FVTPL. But these are pretty rare scenario. This don't happen normally. Okay. Such kind of instrument standard allows you to classify on day one as FVTPL. Okay. After that, you cannot change the classification. However, since on day one you are applying Indian GAAP, you are not applying IndAS at all. So you never knew that you had this option under IndAS and all that. So on the date of transition, you can exercise this option. Similarly, paragraph 2 talks about equity instrument. In equity instrument, you have one-time option to classify investments in equity as FVOCI. Otherwise, normally all equity instrument will be measured at FVTPL. On your initial recognition, you have option that you classify it as FVOCI. So since on the date of purchasing the equity instrument, you were under Indian GAAP. You did not have this option. So now when you move to Ind AS, in the opening balance sheet, you have this option of classifying this investment in equity instrument as FVOCI. Okay. Sanjay has a question. Prior to transition, we had investment in bank sovereign gold bonds, investment in NSC, and investment in shares of the cooperative banks. At the time of transition, how these investments are to be accounted for? So Sanjay, firstly, at the time of transition, you have to go through, see, first of all, bonds are debt. Okay. NSC, National Saving Certificates, they further invest in debt. So these are also debt. Okay. Cooperative bank shares are equity. So first you have to distinguish between debt and equity. For investment in debt instruments, you have to follow that SPPI test and business model test to decide whether it will be amortized cost, FVOCI or FVPL. For cooperative bank shares, because these are equity in nature, okay, you have two options. Either you classify them as FVTPL or FVOCI, and once you decide the option, you cannot change ever. Okay, so that's how you will have to do this accounting for all these investments that you have on the date of transition. Okay, there are a couple of more, I think two more exemptions which I have to discuss. The first one is decommissioning liability. Okay, I've been saying decommissioning liability since last 2.5 hours now. Multiple times I've said decommissioning liability. Okay, let's go to Excel and see how accounting for decommissioning liability happens. Okay, so my PP is 100. I expect to incur decommissioning cost in 2050, okay, of 100 more. Okay, I am normally required to discount it. Okay, I am suppose in 2010 I purchased PP. Okay, discount, let me make this 200, let this be 100. Okay, discount decommissioning liability of 100 for 40 years, 2050 to 2010. Okay, suppose this discounted amount comes to say 70. So my PP will be 200 add decommissioning liability 70. So PP total becomes 270. And I have on the liability side, so this is assets. On the liability side, I have decommissioning liability of 70. Okay, this is 2010. If I go to 2011, I will depreciate. So PP opening balance is 270 less depreciation, say 27. So net balance is 270 minus 27. Okay, then I have on the liability side, I have decommissioning liability, opening balance 70, add interest of say 7, closing balance. Okay, so basically slowly this 70 will go to PNL as depreciation. So from 2010 to 2050, there will be depreciation expense of 70 and there will be interest cost of 30. So that's how I will have 100 in PNL relating to decommissioning costs. Okay, this is my normal accounting for decommissioning liabilities. Okay, normally I do this. Now, how did I discount? The discount rate I have used is applicable as at 1st April 2010. Okay, useful life for depreciation. Different for every year from 2010 to 2050. It can be anything, right? Every year it may change, every year it may be same also, but I'm just saying you reassess useful life for depreciation every year. Now this is my normal accounting. Okay, what is the relief here? There's no relief as such, right? So the relief which IndAS 101 gives is, I am now in 2018. Okay, this is my normal accounting, but actually I have applied in 2018. Now 2018, what do I do? Okay, how do I do it? What I do is, for PP, for PP, okay, I arrive at the same thing, okay, which is 270. Okay, so I use 270, but I depreciate using useful life as at 1st April 2018. So relief number one, this is relief one. Relief two is for decommissioning liability, 100 discount using rate, interest rate as at 1st April 2018. Is this clear? These are the two reliefs given by the standard. Let me go back to the slide. Okay. So I'll read out the slide for you. Firstly, it says that measure the liability as at the date of transition. So I said decommissioning liability, relief number two, that you can measure the decommissioning liability as at 1st April 18. Second point, it says estimate the amount that would have been included in the cost of asset when the liability first arose, which is 2000, year 2010. Okay, by discounting the liability to 2010 using the best estimate of 2010's discount rate. Okay, and then calculate the accumulated depreciation as at the date of transition on the basis of current estimate of useful life. So relief number one is useful life you need to take as on 1st April 18. So only two relief. You are allowed to take useful life of 1st April 2018, so that every year you don't keep on reassessing the useful life. And secondly, relief number two is for liability side, you can measure the liability using the discount rate which is applicable as on 1st April 18. Only two relief. Every other accounting you need to do. Is there any questions on this? Okay, Sanjay has a question. Pre-transition, pre-operative expense were capitalized in PP. Post-transition, can we continue to capitalize? No. Post-transition, Sanjay, you cannot continue to capitalize. But if you choose the option of the fourth option, which I gave in property, plant and equipment, which is your carrying value as per Indian GAAP becomes deemed cost as per Ind AS, then the old whatever you have capitalized, that will continue, but the new expenses you cannot continue to capitalize. Okay, so what you have already capitalized, fine. New capitalization not allowed. Yeah, I hope Sanjay I'm clear. And also on decommissioning liability, if there's any question, please feel free to ask. Otherwise, I'll go to the next slide. Last is short-term exemption from Ind AS. So Sanjay, that paragraph is in Ind AS 16 because after transition date you have to follow Ind AS 16. Ind AS 16 does not, or there is no, see, previously there was a concept of pre-operative expense capitalization. Ind AS 38, which is on intangible asset. Okay, that standard does not allow you to capitalize any miscellaneous expenses kind of nature. You are not allowed to capitalize, you are not allowed to carry in your balance sheet. Okay, it does not fulfill the requirements of asset. So under Ind AS 16, under Ind AS 38, you are not allowed to capitalize any pre-operative expenses, okay, unless this relates to a specific asset. So if it relates to construction of machine, factory, any such thing, construction expenses, you can capitalize, but normal pre-operative expenses which are revenue in nature, you cannot capitalize, which you are allowed to do in Indian GAAP that you are not allowed to do under Ind AS. In fact, under Indian GAAP also, after AS 26, I think it was in the year 2005 or 6, somewhere in 2000s, after AS 26, you are not allowed to capitalize pre-operative expenses under Indian GAAP also. Okay, so short-term exemptions from Ind AS. Okay, uncertainty over income tax treatment. Now this is a new standard or new thing which came from 2019, 1st April 2019. Okay, very interesting concept. Okay, the concept says that suppose I have been, I have been claiming certain expense in my income tax. In my income tax computation, I've been claiming certain expenses since last 7 years or so. Okay, now today or this year, income tax has decided to open assessment for one of the years, past years. Okay, say 5 years back, it has opened some assessment. And in that assessment, it has decided to disallow that expense. Okay, if it has decided to disallow that expense for a particular year, which is a 2015, I know that I've claimed same expense in 16, 17, 18, 19, 20. Okay, now hence, when I calculate my tax, okay, I need to consider that these expenses may be disallowed, and depending upon the probability, whether it is possible, probable, depending upon that criteria, you decide whether it's a contingent liability or it's a present obligation and you need to book for expense and liability today. So even for 16, 17, 18, 19, 20, where the assessment is not opened, okay, you need to either show it as contingent liability if it's possible. If it's probable, then you need to account for expense and liability for those, assuming that it will be disallowed for those years as well. Okay, that is the requirement as per this new guidance on uncertainty over income tax treatment. Okay, in short-term exemption, it just says that if for the first time you are applying Ind AS in the year March 20, okay, then for the comparative year 18-19, you need not allow this guidance, you need not apply this guidance. This guidance may be applied only from 1st April 19 onwards. So it's a short-term exemption which has been allowed for only 1 year. If you apply Ind AS in 2021, okay, then this short-term exemption will not apply to you. So this short-term exemption is only available for 1 year. That is, if you first time prepare Ind AS in the year 1920, only in that year this short-term exemption will apply. After this, this short-term exemption goes away. Any questions on this? Okay, so then there are disclosures. Okay, there are a lot of disclosures under IFRS, you are aware. Some of them I have said, there are disclosures relating to reconciliation of equity. You have to give two reconciliation of equity, which is balance sheet equity reconciliation as on 1st April 18 and as on 31st March 19. So two equity reconciliation and one P&L reconciliation, which is profit as of 18-19 for the year 18-19. Okay, then you need to give material adjustments that were made in adopting Ind AS in balance sheet, P&L, cash flows. If there were errors, then you need to disclose those errors separately. Okay, if any impairment loss is reversed, then you need to disclose that separately. You have to give explanation regarding which optional exemption you have taken, which optional exemption you have not taken. Okay, so you need to give explanation regarding format of reconciliation. If you see balance sheet, each line item, what is as per Indian GAAP, what are the adjustments you have made, what is as per Ind AS. Okay, for each line item, and there are notes A, B, C, D, E. In notes, you will explain what are the major adjustments which you are doing, why you are doing such adjustments, what exemption you have taken, what you have not taken. So all those things you will explain in notes. Similarly, liability side, Indian GAAP balances, adjustments, Ind AS, and for each adjustment there is a note. So you need to explain via note. And same thing for P&L. If you see each line item of P&L, Ind AS, adjustments, sorry, Indian GAAP, adjustments, Ind AS, and for each adjustment there is a note. Okay. So that's it from my side. If there are any other questions which you have, I can take up those questions now. Otherwise, I am through with the standards. Sanjay, relevant para of Ind AS 16, Ind AS 38. I don't have specific para numbers right now, but I am very sure that now we are not allowed to capitalize even under Indian GAAP. AS 26 also prohibits, and Ind AS definitely prohibits. Only, like I said, construction expenses, construction of assets, which was previously also allowed under AS 10. Okay, that kind of expenses which is specific to an asset can be capitalized. Generic revenue expenses which are pre-operative in nature, means before you start production, pre-operative revenue expenses not allowed to capitalize.
Yeah, Grishma, take over.
Yeah. So we come to an end to another enriching weekend. So I would like to thank CA Anand Banka for his valuable time for sharing such insightful thoughts on the accounting standard and explaining it in a very lucid manner. I would like to thank people behind organizing this seminar, especially Vijay Kevalramani sir and Tax Practitioners Association of Thane and its core team. Kudos to your commendable efforts, sir. And last but not the least, the lovely audience for keeping the session very interactive. So I believe sir must have felt throughout that he's conversing
Absolutely.
in a normal environment rather than on a Zoom TV.
Right,
Thank
right.
you all. And over to you, Vijay, sir.
Thank you, Grishma, for conducting the session beautifully. Thank you, Anandji, for accepting our request and enlightening and guiding our audience. Friends, this was supposed to be the last, but because, as you know, we had to postpone 2 sessions. So our next will be on the 19th by CA Rajesh Modi, Ind AS 40 and 41. The links will be the same that were given. That is for day 5. So kindly take note, the day 5 links will be active for YouTube as well as Zoom. So kindly log in through that. And we'll have our last session on the 20th. That will be the day 8 of CA Deepak Jaiswal, which was postponed. So that would be the last session. And important announcement relating to the issue of certificates will also be made on that day.